So that sound you hear, perhaps mortgage borrowers across the country breathing a sigh of relief, getting a little bit of space to deal with their finances after 8 consecutive increases to interest rates. We saw the Bank of Canada hold on rates at its 9th meeting. That's the first time that they have put their pause into practice. Now, this was widely expected. Nevertheless, you are seeing some pressure on the Canadian dollar as people were wondering, well, would the BOC actually follow through? Would they add in some hawkish words to match some of the sentiment that we are seeing south of the border? We didn't get that. Let's bring in Karen Weaver, who's the president and CEO of MCAN Financial Group. Karen, let's talk about what this means for the mortgage market, how material it is to now at least be on a pause. How are you thinking about it?
Today, I'm relieved. We believe that we needed a pause for now for a couple of reasons. One, borrowers need some time. They need some time to manage down their debt. They need some time to adjust to these new mortgage levels. So I think it's also important in general for the economy just to pause and not overcorrect. So if you look at it from a borrower perspective, what we're seeing is that, and we've read this in the papers, we've all read this, that the borrowers are going to be facing with a $500, $800 increase in their mortgage payments every month when they come for renewal. Now, about 17 to 18 or 19% of the mortgages in Canada mature every year. So that means a lot of our borrowers, or a lot of the borrowers, the mortgagors in the country, they have time to get ready for this. But we do need the pause. Mortgage rates will be going up, and I don't believe that they're ever going to come down. We will never see them again at the rates we saw during COVID. So I think it's really important that homeowners and people who are looking for homes understand that they need to be able to afford this kind of a mortgage rate.
That's important to underline because I think there's some thinking, whether it's thinking or hope, that we're going to get back to the good old days of zero interest rate or no interest rate, negative interest rate policy. And you, as somebody who invests in mortgages, you don't see that day ever coming back?
No.
Why?
Because I think we've learned once again the damage that overcorrection can do. When I say the damage of overcorrection, I mean, I'm talking about the COVID. We left our rates too low for too long. And by the way, this is exactly what happened in the United States in '07. And when they had their real estate crisis, financial crisis, which was not a crisis for Canada, but it was for them. But that was exactly the issue. So we are now correcting for that overcorrection during the COVID years. And that's why I say it's important. So, you know, the Bank of Canada has a very difficult challenge, I believe, to manage a soft landing, because they not only have the war and the oil and gas price impacts, but they also have the CAD-US dollar to manage. And this is not a new space for this country. We've had this problem in the past. I can remember same scenarios in terms of what happens to the Canadian dollar. If we don't maintain the interest rates to a level that keep a good relationship between Canada, US dollar, then we end up creating more inflation.
So I'd love to get your perspective. If we're never going to see those low rates again, does that mean we stay where we are right now in the 4%, 5% range? Are you talking about going back to 17%, which nobody wants to go to? No. Is it a variable mortgage dead in the water? Should you never take that exposure now? Walk us through those, how you're thinking about that.
Okay, so first off, will we see 17% again? I don't believe so, not in this cycle. In the future, I don't know what dynamics would bring that on. But we have too many other dynamics pushing us down to some sort of a moderate interest rate level. So the mortgage levels will follow those rates, okay? If the rates are never going to go down to 1% again, that means that the mortgage rates will never go down to 1%. Or maybe even 2%. So if I was counseling, let's say my team or a family member, I would say you need to plan on a mortgage that is going to be priced somewhere between 3.5 and 5.5 over the longer term. You might have a few wins here and a few peaks there, but over the long term, what we have had in the past will not continue in terms of those low rates.
So let's talk about what this means then. Can the Canadian real estate market withstand that? One of the things that has proven to be very resilient, you saw that show up in Canadian bank earnings. You know, demand for mortgages certainly is down, but you're not seeing cracks, meaningful cracks in terms of defaults, credit defaults. Do you think that we're still in wait and see mode, that we could start to see those cracks forming?
Canadian homeowners have their homes at the forefront of their heart, their life, and their checkbook. So Canadian homeowners make every effort to protect their shelter and to make that house payment, even if they have to give up on other things. Those are the choices that Canadian homeowners have historically made. I don't see any change in behavior. Our mortgage rates, or the default rates, and the ones that we see in the market are extremely low, extremely low. I am not worried at this time about any sort of drastic change in that scenario. There will be borrowers who have trouble. There's no question. But homes and family are the most important thing. And I think maybe that's what's changed in the last couple of years is maybe some of the investing mentality. We primarily deal with owner occupants, and that's important as well. But what's holding up everything, holding up what I mean positively as a base, is the housing shortage and the growth in the population and the households. And as long as we have that, we have some stability in our economic structure in Canada. And the key there then is to bring more affordable housing to people who want and need homes.
It sounds like you're not worried about cracks showing up in residential, but I know you also invest in mortgages in commercial. Is that an area then you could start to see those cracks forming because it doesn't have the same emotional relevance?
Right. So our book is in a really good state. And I have a lot of interaction with other players in the markets. And I can tell you that, yes, interest rates have gone up because construction mortgages for companies that build housing have gone up because of interest rates, full stop. So their rates are rising. We monitor this very closely. We have no issues. What's interesting is that it's all about timing of a sale and the values in the markets. We're still seeing higher values on the homes that are closing now than when they were bought or committed to by the buyer. The ones that you want to worry about the most are really the homes that were sold in the last 3 quarters or before, let's just say from the last 3 quarters of 2021 into the first quarter of 2022. After that, everything adjusted.
Okay.
Everybody had to adjust. Sales went down. Values of homes went down. So it's a very small number that we need to worry about. But we do need to get housing affordability balanced between a mortgage rate and a housing price so that our country can buy houses.